$150,000 tax bill story. A few years ago, I had a client who owned a two-family home in Jackson Heights for almost 20 years. It was a beautiful property, well maintained. He had watched that building go from $400,000 to being worth over $1 million. He had $600,000 in equity that he had built up over 2 decades of owning that home. He was ready. He was ready to sell, he was ready to move on, and he was ready to upgrade to something bigger out in Nassau County. We listed the property, we got a phenomenal offer, and then his accountant called. The capital gains tax bill on that sale was over $150,000. He almost pulled out of the deal entirely. And honestly, I almost lost the transaction because nobody had talked to him about a 1031 exchange before we went to the market. We caught it just in time. He did the exchange. He rolled every single dollar of that equity into a new investment property, and he paid $0 in capital gains tax that year. $0. Now I want you to think about that. $150,000 staying in his pocket, going on to his next property, working for him instead of going to the government. This story is why I'm making this video. If you own a rental property, a 2-family, a 3-family, or any investment property in Queens or Long Island, and you've ever thought about selling, upgrading, or making a move, you need to understand this strategy before you do anything else. I'm Maureen Folan. I'm a licensed real estate broker with over 25 years of experience in selling in Queens and Long Island. I've helped hundreds of investors and property owners make smart moves in this market. And today, I'm going to walk you through everything and exactly how a 1031 exchange works. The deadlines you absolutely cannot miss, real examples from our market right here, and the mistakes that cost people everything. So stay with me. This video could be worth more to you than anything else that you watch today. Before I get into it, if you're a property owner in Queens or Long Island and you want real local information about this market, not generic national content, but actual strategies that apply right here in our market of Queens and Long Island, hit subscribe and turn on notifications. I put out new videos every week covering the Queens and Long Island real estate market specifically, over 25 years of experience. There's nobody else in my community doing this at my level, so subscribe now. So what is a 1031 exchange? Let's start with the basics. The name comes from Section 1031 of the Internal Revenue Code, the federal tax law. And what it says in plain English is, if you sell an investment property and you use the money from that sale to buy another investment property, you can defer paying capital gains tax on the profit. Defer, not eliminate. That's an important word and I'll come back to it later. But defer means that you don't pay it now. You kick that can down the road. And for most investors, down the road never comes because they keep exchanging into new properties. Let me explain why this is such a big deal. When you sell a property you've owned for a long time, anytime you make money, the IRS wants a piece of the profit, your capital gain. In New York, between federal and state taxes, you could be looking at anywhere from 20 to 35% of your gain going on taxes. On a $500,000 gain, that's $100,000 to $175,000 right out of your pocket in taxes. Money that could be working for you in your next investment. The 1031 exchange lets you keep all that money working for you instead of sending it to the IRS. And here's the really powerful part. You can do it over and over and over again. You can exchange once, then exchange again, and then exchange again, rolling your equity forward every time, growing your portfolio and deferring the taxes indefinitely. Some investors do this their entire investing career and never pay capital gains tax on their real estate at all. This is not a loophole. This is not a trick. This is a federal law that has been in the books for over 100 years. Congress created it specifically to encourage real estate investment and keep the capital flowing in the market. And yet most property owners in Queens have never used it because nobody ever explained it to them until today. Okay. Here are the property rules. So who does this apply to and what properties qualify? The IRS has specific rules here. Let me break it down simply. To qualify for a 1031 exchange, your property must be held for investment or used in a business. That includes rental properties, 2 families, 3 families, 4 families, yes, multi-unit apartment buildings, yes, commercial real estate, retail, office, mixed use, yes. Vacant land that you're holding onto as an investment, yes. Even a single family home that you rent out, yes, if you own it and you rent it out, in most cases, you qualify. Now, what does not qualify? Your primary residence does not qualify. The home where you live in, where you sleep every night, that's excluded from the 1031 exchange rule. Your primary home has its own separate tax exclusion, the $250,000 to $500,000 exclusion for a married couple, which is different. We can cover that in another video. Properties you bought to flip do not qualify. If you bought a property specifically to renovate and then resell quickly, the IRS considers that inventory not an investment. It needs to be a property you held as an investment. And here's the question I get all the time in Queens from homeowners. Maureen, I live on the first floor of my 2-family home and I rent out my second floor. What about me? Do I qualify? The answer is it depends. And it's more complicated. Part of your property, the rental portion, may qualify for a partial exchange, but you need a CPA who truly understands this. And I work with several ones that specialize exactly in this situation in the Queens market. I'll get into that at the end of the video. But the bottom line, if you own a rental property in Queens or Long Island, there is a very good chance you qualify. And if you're not sure, that's exactly why I'm here to help you figure it out. The most critical part of the whole video. All right, now we get to the part that I really want you to focus on, because this is where the deals go wrong. This is where people make a lot of mistakes and do not qualify for this exchange. They lose the tax benefit after they've already sold their property, and there's nothing they can do about it. So make sure you pay attention and you take note. A 1031 exchange has 2 hard deadlines. Miss either one and you lose the tax deferral. The IRS does not grant extensions. They do not make exceptions. There is no I didn't know or it doesn't matter. So please write these down. Deadline number 1 is 45 days. The identification deadline from the moment you close on the sale of your old property. The clock starts ticking. You have exactly 45 days to identify your replacement property in writing. Not 46 days, not 50 days, 45 days. You submit a written list of potential replacement properties to your qualified intermediary. I'll explain what that means in the next segment. With those 45 days. Now there are rules about how many properties you can identify. In New York, at this time, you could identify 3 rules. The simplest rule and the one that most people use is the 3 property rule. You can identify up to 3 replacement properties regardless of their value. Most investors pick 3 and then zero in on the best one. There's also a 200% rule. You can identify more than 3 properties as long as their combined value does not exceed 200% of what you sold. And a 95% rule for larger portfolios, but those get complicated and you'd want a specialist for those. My advice, identify up to 3 properties, have your number 1 target locked in before you even close on your sale. That's how you set yourself up for success when it comes to 1031 exchanges. Deadline 2. This is also really important. 180 days. The closing deadline, once you close on the sale of your old property, you have exactly 180 days total to close on your replacement property. 180 days from the closing to the closing. Now this is important. Those 180 days include the 45 days you already used to identify. It's not 45 plus 180 days. It's 180 days total. And your identification has to happen within the first 45 of those 180 days. So the real window you have to actually close on your new property is the remaining 135 days after your identification deadline. In a market like Queens or Long Island, where inventory moves fast, attorneys can take time, and titles can be complicated, 135 days to find a property, negotiate, go into contract, and close is not a whole lot of time. This is why I tell every client you need to start thinking about your replacement property before you even list your current one. Not after you sell, but before. When we work together, I run this process in parallel. We market your property for sale and we start identifying potential replacement properties at the same exact time. So the moment you close, you already know where you're going. That's how you protect yourself. That's how you don't lose the exchange. I want to stop here for just 1 second. If you own an investment property in Queens or Long Island and you just learned something that you didn't know about these deadlines, that's exactly why I make these videos. I've been selling real estate in this market for over 25 years. I'm a 2nd generation realtor. I do hundreds of transactions every single year, so there's nothing I haven't seen. And I've seen it happen. And believe me, every property owner deserves to know these things before they make a decision. If you're getting value from this video, please subscribe. New content every week: Queens market updates, Long Island market updates, investor strategies, real deals, real numbers. Nobody else is doing this for our market the way I am. Hit subscribe and let's keep on going. The actual process. Okay, so now let's walk you through exactly how a 1031 exchange actually works from start to finish, step by step. Step 1, decide you want to do a 1031 exchange before you list. This is the most important step. The decision to do a 1031 exchange must be made before you close on your sale. You cannot decide after the fact. You cannot get the money from the sale first and then try to do an exchange. Once that money touches your hands, the exchange is dead. So before you even list your property for sale, call me. We'll talk about your goals, your timeline, and whether an exchange makes sense for you. Step 2, you have to hire a qualified intermediary. We call them a QI. A qualified intermediary, also called QI or an accommodator, is a neutral third party whose job is to hold your sale proceeds while you identify and close on your replacement property. This is required by law. You cannot touch the money between the sale and the purchase. It has to go directly from the buyer of your old property to the QI, and then from the QI to the seller of your new property. If this money hits your bank account, even for one day, the exchange is invalid. Your QI is not your attorney, it's not your accountant, or your real estate agent. They have to be a truly independent third party. I have qualified intermediaries I trust, and I recommend them to my clients. I've personally done 1031 exchanges, so I know who to use, and we do this every single day in New York. Step number 3, you have to sell your property. We list your property, we find a buyer, we negotiate the best possible price, and then we close. At closing, the proceeds go directly from your qualified intermediary, not you. The 45 and 180-day clock starts at the closing date. Step number 4, identify your replacement property. Within 45 days of your sale closing, you submit your written identification up to 3 potential properties to your QI. We'll already have been working on this in advance, so this step is a formality, not a scramble. Step number 5, you go into contract and you close on your new property within 180 days. We negotiate you into contract. We help you close on your replacement property within the 180-day window. The QI releases the funds directly to the seller of your new property at closing. And step number 6, you file with the IRS when you file your taxes. You report the exchange using IRS Form 8824. Your CPA handles this. It documents the exchange and it establishes the deferred tax for the future. And that's it. It's 6 steps. Your equity is preserved, your capital gains tax is deferred, and you own a new investment property. The key to making this work is preparation. Starting early, having the right team, a great broker, a qualified intermediary, and a CPA who knows investment real estate in New York, which is exactly what I put together for my clients. All right, let's make this real with some actual scenarios from the market. These are the kinds of situations I work with every single day. So here we have an example, the Jackson Heights 2-family upgrade. Let's say you bought a 2-family in Jackson Heights in 2008 for $550,000. Today it's worth 1.2. You've got $650,000 in equity. If you sell without a 1031 exchange, your capital gains tax, federal plus New York State, could easily be $130,000 to $180,000. Gone. With the 1031 exchange, you sell your property and your QI holds on to the proceeds and you invest it into a 4-family in Fresh Meadows, or a commercial property in Flushing, or a multifamily in Nassau County. Your portfolio grows. Your tax bill is deferred, your equity keeps on working. Example number 2, the Queens to Long Island move. This is a very common scenario in our market. Investor owns a 2-family in Bayside. They're done managing tenants in the city. They want something newer, easier to manage, maybe in Nassau or Suffolk County. They've had the property for 15 years, massive appreciation. Without a 1031 exchange, selling means a big tax bill. With the 1031, they can sell the Corona property, identify a property in Long Island, maybe a small commercial building or a well-maintained multifamily in Nassau, and exchange into that. They get out of the city, they get a newer property, and they keep their equity intact. This happens all the time, and this is one of my favorite transactions to put together. In fact, I'm personally going through this scenario myself. I'm selling a 2-family in Queens, and I'm rolling it into multi-unit in Nassau. So here's something important. You could trade up in value with the 1031 exchange, and you should. The rules say that you could fully defer your taxes. Your replacement property must be of equal or greater value than the property you sold, and you must use all the equity. If you buy something cheaper or keep some of the cash, that leftover cash is called boot, and it is taxable. So the strategy is always trade up, or at minimum, trade equal. Client sells a $900,000 2-family, they buy a $1.2 million property, all equity goes in, 0 tax, portfolio grows, and that's the play. So let's talk about example number 4, the estate planning move. This is the one for the long-term thinkers. Let's say you do a 1031 exchange now, defer your taxes, and you hold that new property for the rest of your life. When you pass, that property goes to your heirs. Under the current tax law, they receive what's called a stepped-up basis, meaning that the capital gains tax that was deferred could potentially disappear entirely. Your heirs could sell it and pay little or no capital gains tax at all. Now, I'm not a tax attorney, and tax laws can definitely change, so you need to work with an estate attorney and a CPA to plan this properly. But this is why serious real estate families in Queens and Long Island have been using 1031 exchanges as a generational wealth building strategy for decades. This is not just about saving money for today. This is about what you leave behind. This is the 5 biggest mistakes that I see people make with 1031 exchanges. I've been doing this for over 25 years. I've seen investors save hundreds of thousands of dollars with 1031 exchanges, and I have seen investors blow the exchange and lose it all because of avoidable mistakes. Here are the 5 biggest ones. Mistake number 1, deciding to do a 1031 exchange after you've already closed. I cannot tell you how many times people call me after they've sold their property and ask me about doing a 1031 exchange. Once the money goes from the sale, goes to you, it's over. You cannot go back. The decision must be made before closing, not after. Mistake number 2, missing the 45-day deadline. Life gets busy. You close on your sale, you're dealing with the move, dealing with tenants, dealing with everything else, and day 46 arrives and you haven't identified a replacement property, the exchange is dead. Tax bill is due, no exceptions. The solution? Start identifying your replacement property before you even list your current one. When I work with exchange clients, we run these 2 sides of the deal in parallel. Mistake number 3, not using a qualified intermediary. Some people try and save money by having their attorney or their accountant hold the funds. That's not allowed. The IRS requires a truly independent qualified intermediary. Using a disqualified person, even someone you trust, invalidates the exchange. Use a licensed, experienced QI, period. And mistake number 4, buying down in value. If you sell $1 million property, you buy an $800,000 property, that's a $200,000 difference. That boot is fully taxable. People sometimes do this without realizing it because they want to buy something smaller or keep a little cash. If you want to keep cash, there are ways to structure it, but you need to know this going in so you don't pay taxes on whatever you don't reinvest. Plan this up front. And mistake number 5, not having the right real estate team. A 1031 exchange only works if everything was fast and clean. You need an agent who knows the inventory, that can move quickly and get you into contract and understands the timeline pressure you're under. If your agent is slow, if your replacement property falls through at day 40, if you can't find something that works in time, you miss the deadline and the exchange fails. This is why working with someone who does this regularly in your specific market is so important. Not someone who does it once in a while, who's not really sure of the rules, someone who is experienced in this. In Queens and Long Island, that's me. So let me tell you exactly what it looks like when we work on a 1031 exchange together. First, we have a conversation. You tell me about your property, your goals, your timeline, and what you're looking to move into. I'll give you my honest assessment of your property's value in today's market and why you could realistically buy with your equity on the other side. Then we build a plan. We identify target replacement properties while we're marketing your current property. We line up a qualified intermediary. We make sure your CPA is looped in from day 1, and then we execute. I list your property, we find a buyer, we negotiate the best deal, and the moment you close, I already have a replacement property lined up for you to move on to. We work the 45-day clock from a position of strength, not panic. I've been doing this in Queens and Long Island for over 25 years. I know the multifamily market, I know the investment property market, the neighborhoods, the price points, and the timing. I have relationships with qualified intermediaries, real estate attorneys, and CPAs who specialize in investment property transactions in New York. I'm not just your broker, I'm the person who coordinates the entire process and makes sure nothing falls through the cracks. If you're thinking about selling your investment property, whether you're ready to move now or you're just starting to think about it, call me. Let's talk. There's no pressure. No commitment, just a conversation about what your options are. Because the worst thing that can happen is you sell a property without knowing what tools are available to you. All right, here's what I want to do with you right now. 3 things. Number 1, if you own an investment property in Queens or Long Island, a rental, a 2-family, a multifamily, mixed use, anything, and you've been thinking about selling, I want you to call me or text me directly. My number is on the screen now and it's in the description below. I will pick up the phone. Please send me a text message. I work with investors every single day in this market, and I would love to talk to you about what your property is worth and what your options are. Number 2, I want you to subscribe to this channel. I put out new videos every single week covering the Queens and Long Island real estate market. They call me the Queen of Queens and Long Island. I know it cold. Investment strategies, market updates, seller tips, neighborhood by neighborhood breakdown. If you want to own a property here or you own a property here, this channel is built for you. Hit subscribe and hit the bell so you don't miss anything. And number 3, share this video with someone who needs it. You probably know someone who owns a rental property in Queens or Long Island and has no idea that this strategy exists. Send them this video. You might save them 6 figures, seriously. I'm Maureen Folan, the Queen of Queens and Long Island, and I'll see you in the next one.